My name is Richard Delavan. I am the host of Wicked Problems Climate Tech Conversations. I'm delighted to be here at Reset Connect with an excellent panel to talk about, let's talk about navigating the growth stages of capital raising. And today we have an excellent panel to talk about that. Scaling climate solutions in this space, Series B and beyond. We're here to talk about what it really takes for climate tech companies to make the leap from early promise to scaled impact, and why Series B is often, or in later stages, often the hardest money to raise. It's a point where investors are really looking for revenue, looking for profitability, looking for good unit economics, and the dreaded valley of death is what founders are staring into often. So not to scare anybody, not meant to be a scary panel, but we've got some great folks who are going to help us navigate that valley of death. Starting with, on my left, James Tortoshell, Investments Director at M&G Catalyst. We have Sander Pilkenwood, CEO of Dutch Cleantech, and Paul Gilligan, CEO of Magical Mushroom Company. So, James, maybe just explain a little bit about your own perspectives on where we are in terms of what you guys do in raising Series B and beyond.
Yeah, happy to, and just checking everyone can hear me as well. So I'm a director at M&G Investments. I sit within our private markets business. M&G as a whole has a real focus on integrating sustainability across a whole range of asset classes and strategies, and really central to that is the strategy I represent, which is called Catalyst. This is a £5 billion commitment from our internal asset owner, the Prudential, to really back entrepreneurs scaling really impactful technologies at the growth stage. So we typically come in actually Series B onwards. We have very patient capital, so can hold those investments all the way through to the public markets. And we invest under 4 core themes, so planetary health, human health, access and inclusion, and enabling technologies, which is things like AI and quantum computing that really sits across those 3 themes. We invest across both hardware and software, which is obviously relevant in the climate tech space. A lot of these technologies are capital-intensive hardware solutions, and we invest globally. And I think a real key differentiator and value add that we offer to our founders that we back and the portfolio companies is that we're part of this wider M&G platform, and so that really allows us to support founders throughout the life cycle of their funding requirements. And then lastly, we have a very big public equities franchise with a number of sustainability-focused funds really well aligned with Catalyst. So again, just allowing us to provide that life cycle capital, which we think is really critical in terms of scaling these solutions and getting through that valley of death.
Right. Sander.
Yes, happy to be here. Let me tell you something about myself, but let's talk about water first, because that's what we do. I think water is one of the most undervalued and still underinvested industries globally, but that's going to change. To put this into perspective, if you look at the energy transition, $2 trillion is being invested there yearly. And in the water industry, we're talking about just 41 billion. So that's 0.2% of what we invest in the energy transition. And it's funny because we need water for the energy transition. But not only that, let me begin, by the way, saying my name is Sander Pilkenrood. I'm the CEO of Dutch Cleantech. And Dutch Cleantech is an offspring of Pilkenrood, a family company, family-owned, a specialist in water treatment, or building a water treatment plant since 1962. So we've been around for a long time. So I was saying it's strange that water is underinvested because we use it every day, everyone. Not just consumers to drink and to wash and to cook, but also companies to produce all types of goods. I mean, everything you see around you has been produced by using water, and that's the same with the energy transition. Everything that we need for that, all those goods are being produced with water. So I see a lot of potential in the water industry. So what do we need to do? What happens right now is that actually we take water from nature, from lakes and rivers and from the sea, or groundwater, and we use it. And in 80% of the world, 80% of the cases, we give that water back untreated to nature. So that went okay for, I don't know, 100 years, but with growing population, growing consumption, everybody understands that this is not a sustainable situation. So what do we have to do? We have to invest in water treatment plants. And that's exactly what Dutch Cleantech does. We combine the expertise and the experience of Pilkenrood, so my family company, with our own investment fund. So we set up in 2022, we set up a fund at this moment in the Netherlands where private investors put their money, and we use that money to build water treatment plants. And we have concession agreements with governments or with private industries to supply them, so they outsource their water treatment basically to us. So when we supply them with clean water, we charge them per cubic meter. So they don't have to build anything, they don't have to invest in anything, they don't have to research all these technologies. We do that for them. And if we do not meet the requirements that we agreed upon, so the treated water requirements, they don't pay. So that's our commitment. If we're looking at the future, the Dutch Clinic was established just 3 years ago. This year we expect an order intake, and we're on target, pretty much on target, in Latin America of $200 million plus. And to fund all those projects, we are setting up a pan-European investment fund in Luxembourg, because from Luxembourg you can fund all over Europe, including UK, and actually also in the USA. We plan to hit the 1 billion target before 2028 of investments of order intake. So there is a lot of, and we invested. I forgot to say that we invest all the plans by issuing bonds. So private investors buy bonds, and not just private investors, because the Luxembourg fund will issue 300 million euros worth of bonds this year, and that's not just for private investors but also for institutional investors. And apart from that, to finance the expansion of the company, to enter into new markets, to attract more people, we are selling 10% of our shares later this year. So there's a lot of development actually going on.
Fabulous. And Magical Mushroom Company, Paul, I suppose you guys must use a lot of water as well.
Certainly do. Nice to be here. Yes, I'm Paul Gilligan, the founder and CEO of the Magical Mushroom Company. And whilst we've got a fun name, we are a serious business, and our business is to disrupt and replace polystyrene as a packaging solution. So we use mycelium, the root structure of mushrooms, as a binding agent, as a natural polymer. Now, whilst it's the smallest percentage of the recipe, it's the most important, and we use that to bind together agricultural waste. And in the main part, hemp shivs, the woody core of hemp or rapeseed, and over a process of a few days, the hyphae spreads through that raw materials and becomes a solid part. So my drive really seems to be perpetually investment round. We haven't actually reached Series B yet, but probably late next year. But the drive has been about price parity, and I always preach that number one, we are an industrial. We keep our people safe. The second thing is it's shareholder value, because that they support the business. And then the incumbent product that we replace, the polystyrene, it has to be as good or better, and the price has to be the same. I haven't believed now or 3 years ago that there's a price premium for green, so we should have to take that price out of the argument, which we have done now. So finally we've reached price parity with polystyrene. We've got one contract which is the replacement of the polystyrene would stretch from Land's End to John O'Groats, and it's 5 million pieces a year. It's the same price, but most importantly now, it's now a very healthy gross profit. So we've built 2 very large factories, one in Nottingham, the UK, which also produces our own raw materials, and one in Bulgaria, Sofia. We chose that factory because it's close to Turkey, which isn't in the EU, as you'll know, but you can get across to there with lots of white goods, which is particularly pertinent now because we just won a £500,000 Innovate grant to scale our white goods solution.
Very good. Right, well, let me just talk a little bit about how things have changed. I mean, I think it's going to be a theme across a lot of conversations here at Reset Connect and across London Climate Week this week about what's different in 2025, versus how things were going a few years ago in terms of the kinds of conversations that are being had between founders and investors, and between investors and how companies have gone. So let me just start with you, James. I mean, what are you seeing in today's kind of growth capital environment that's different than you would have seen 3 to 4 years ago?
Yeah, I think there's sort of 2 time periods there, as you say. 3 to 4 years ago, 2020, 2021, the market was very hot, and it was a lot easier to get some of these big growth rounds done. I'd say then for the last 3 years or so, there's been a challenge. We are still seeing big growth rounds getting done, but they're tending to take longer. Finding a lead investor is certainly one of the key challenges. So advice to any founders is, before going out widely, try and find that lead investor, and then corral followers around them. Within Catalyst, we're happy to lead. We probably lead the majority of the rounds we invest in, but equally happy to co-lead and follow alongside like-minded investors. And then to the point of what's changed in 2025. Obviously we've got the new US administration, and particularly within clean tech, the approach and the support they're showing is obviously a bit less than what the Biden administration has been showing. So I think you're seeing project pipelines to some degree starting to shift back to Europe. There was definitely a pull post the IRA from Europe to the US. Now I'd say there's some shift back, and also to countries like Canada as well, which remain highly supportive of clean tech investments. And then obviously the other key one is trade policy. It's probably too early to really say what the long-term impacts of that are going to be, but clearly potential supply chain impacts for our companies is something we're really focused on, and potential inflation as well.
Got it. And so, Sander, it's a very capital-intensive business. I know you're not building the plants necessarily, but you're actually bringing that expertise and providing, I suppose, like when we talked about this the other day, clean water as a service almost, a kind of a turnkey solution for a lot of these, your customers. But what is the investor appetite like? I mean, how would you describe even the risk appetite these days? Again, as you're getting into these later stages, you mentioned you're going to be selling off 10% of your shares later this year. But in terms of, raising the kind of capital that you're trying to access at this point, what are the conversations like now? Are they different than they would have been a couple of years ago?
Well, in fact, the thing is, we supply a basic need, right? Everybody needs it. I just said that. And if you look at at some other sectors, industries, people might not think that's a basic need. Okay, so you see actually a large shift to things like water, things like food, housing, that everybody needs, always. Economically good times, economically bad times. So we don't really have that problem. And as you said, it is a very capital-intensive business, because a water treatment plant, especially if you're talking about large municipal plants, they're pretty expensive. 100 million plus for one plant. And we do actually build them. And at a certain moment, a couple of years ago, I was thinking, in my country, in Holland, we have 600 billion euros of private savings, just sitting in bank accounts, right? At 2% or even less that time. If you look at Europe, we're talking about 10,000 billion euros. Private savings. I'm not talking about institutional money, just private savings, not asset savings. And all that money is looking for return. And I thought, if we tap into that, and if we go to the people and tell them, look, yes, we give you a good return, right? On when you buy a bond with us, we give you a good return, but it's not just the profit that you make, that I make. It's also something good that we do, because if you treat water, it's good for environment, it's good for public health, and everybody needs it. So to prevent water scarcity. So with us, people really invest with impact, and I think that is what makes a difference, and that's what attracts people to come and invest with us.
I suppose there's a lot of other subsectors, as you say. The water issue is becoming more salient, right? We see more and more stories of cities that nearly run dry,
or run dry,
yeah.
Literally.
Yeah.
Yes.
And so it. I suppose, does that have any kind of effect in terms of the conversations that you do have? You get more inbound, I suppose, when you see these things happen.
Yeah, that's a very valid question, because if I would have started this company 5 years, 10 years ago, I wouldn't have had so much traction, because then the problem was not so urgent, right? People were still pumping up groundwater. They thought it was unlimited, but right now, governments around the world and also companies are finding out that there is a limit to clean water. So the urgency is becoming clear right now, and that's pushing both customers, end users, and investors to us, because we provide a very practical solution.
And Paul, I wanted to come back to you, because I think Magical Mushroom it's interesting. Packaging business is always very competitive. And I think we were talking before a little bit about, and this is a conversation I know happening across the city this week, is whether or not the green premium, whether it ever existed in your business, your sector, but certainly things have changed for a lot of people. How does that affect your story about how you talk to investors about the kinds of things that you're going to be getting into?
Yeah, it's a key point. The landscape's certainly changed for us the last 12 months, really. We're still been able to raise money, but it's certainly a lot slower. Excuse the pun, it's a bit. We moved away from the magic more to the logic of the fundraising. So there's much less appetite for risk. We've got people who've committed to come in on the round, but after the final bit of R&D is done, and they'd rather pay a higher price. So there's certainly a lot of that. But in terms of the the green premium. I think when we started out, we had to put a premium on, a small one, because there weren't contract orders, and we had to prove there was a demand for the product. But we know there's a demand for polystyrene because there's 7,000 megatons produced annually. So that's 7,000 million tons. So it's a huge market. So we did charge a premium at first, but we realised early on that big blue chip clients, repeat orders, industrial scale, would not pay a premium. So we've had a laser focused approach to that over the last 3 years. Very boring, but iterative engineering solutions to get every single bit of yield out of our factories. So we've now got 2 factories open that can produce 40 million pieces. So it's a very ambitious project. And the challenge for me in investment is that we are relying on angel investors when we're in industrial, but we are coming to the end of that journey. But price editing, they won't pay a penny more. We get visibility of that now from, we've got a radiator manufacturer in Europe, a very, very large one. They've given us visibility of the prices, and we can match the polystyrene price profitably. But 3 years ago we couldn't, and they today would not speak to us if we couldn't match that price.
Right. Yeah, and maybe just to come in on that as well, I think that's probably is another change. I think investors across sectors, not just packaging, are that bit less willing to underwrite a business plan showing a significant green premium. I think you really, particularly at the growth stage, you've got to be demonstrating, you alluded to it in the introduction, but really competitive unit economics. You have to be competitive against existing solutions, but also at a price that can deliver you a good margin. And that is critical to investors when we're underwriting at this later stage, as well as seeing that really strong commercial traction. But again, I don't think it's a case of all doom and gloom at all in climate tech, despite some of the headlines you might read. Big rounds are still getting done in climate tech. I think it's more a case of the best companies with the most compelling value propositions, the most competitive unit economics are those that are getting funded. And what we might end up seeing is a bit of a narrowing and a bit more of a centralization on a dominant design, right? And we've seen that across technologies and the benefits of that across sectors. We've seen it in solar PV, we've seen it in wind turbine design, we've seen it in transistors. And I think we're going to start seeing that in some of the really exponential technologies in climate tech as well. When you look at energy efficiency and grid stability and green steel, I think you will start to see that centralization, somewhat pushed by this fundraising environment. But I think there's really significant benefits to that in terms of accelerating the rollout of these technologies that, again, have been maturing for a number of years and are now ready for commercial deployment. And there's an example of that in our portfolio, a business called Submer. We recently led their round, and they are doing immersion cooling for data centers, so replacing air and water-based cooling systems. Now, part of the reason we invested is the sustainability impacts there are huge in terms of reducing electricity consumption and water consumption. But as importantly, the technology's been maturing for 4 or 5 years. It's now ready for commercial deployment. And it isn't just a sustainability agenda that this appeals to with those customers. It has a huge impact on operating costs. And when you look at data centers and the increasing need for cooling, you actually need to move towards these kind of modern solutions. So it's that dual purpose, again, competitive unit economics, but also a very clear sustainability angle that's helping those larger rounds, small growth stage rounds, get closed.
No, I think it's definitely things have changed in that sense. So I think it's really interesting to note from your perspective. Sander, I wonder if we could talk a little bit about the capital stack. So in terms of how things look, you have a quite nuanced model in terms of what you guys are putting together. What have you learned as you've been putting that together that other founders might take away as lessons in terms of, you've got, combining your tech, your operations, your expertise with the long-term concessions? What can other people learn from your experience?
Well, when I first started Dutch Cleantech back in 2022, I thought this is a great idea, right? So we use private capital, also private investors, savings, to fund these water treatment plants. So we solve a problem with private capitals. That was I think, creative. But then I was always used to working with industrial customers, and then I had to work with politicians, and that was something that, these people do things that I had never expected them to do. We had to do with all sorts of legal things, public procurement procedures, and I was not used to that. So that's something I ran into and I didn't expect. So could have prepared myself a little bit better for that. So I think that set us back like a year. But once you overcome that, then I mean, the market is tremendous, and then you have a lot of opportunities when you start understanding how to work with governments, how to work with politicians, and but also pick countries and pick even cities and regions. So just don't give up. That's the thing. Because there's a lot of setbacks, of course. Not everybody likes our idea, or they have their own agenda. Okay, well, forget about that, because maybe the next city they do want to do business.
And in terms of other sources of capital, I mean, you talk about private investment, people's money sitting in bank accounts, basically. But in terms of, the kind of project finance aspect of what you're doing as well, I mean, debt markets, is that something that you're, having conversations about, you say you're issuing bonds, but as a fund, but in terms of like working with institutions?
That's difficult. Actually, we're an alternative to those institutions. If you look at the World Bank or the European Investment Bank, or previously USAID, they don't do that anymore. So I mean, those projects go really very slowly. I was involved in a project in Bangladesh, and it took 7 years for the World Bank to put just the money in place, and that was a fast-track project, right? We can build a whole plan, including getting the finance, in 2 years.
Right.
So that's what we do is a practical, commercial, and it's a private initiative, and that makes us a lot more flexible. And I do understand why those institutions, why they have to. There's a lot of compliance. They have to act slowly. It's public money, so they can't just do the things that we do. But we're a lot more agile, a lot more flexible, and we can offer a quick solution. So that's a big difference.
Okay, interesting. And Paul, I mean, in terms of that yourself, you mentioned that you're dealing with a lot of angels now. You're dealing in other things. I mean, where are you looking, in terms of non-traditional, different sources of capital as you're planning to scale?
Yeah, we've got 120 on our cap table, so it's been pretty busy. So you can imagine how many conversations I've had. So as we go forward, there'll be a consolidation of that cap table, and some of those early investors will exit with very large double-digit exit. So Innovate UK have been very supportive. We got a £1.1 million Innovate loan to open our raw materials plant, and that's had a huge, it's a paradigm shift really in the cost of our raw materials, going from £1.58 a kilo down to 45p. So without that, it would have been impossible to scale. So we're very grateful for that support, low interest, and also the grant as well. So non-dilutive is difficult, as you know, when we're not profitable. Some of the funds as well will not invest until we are profitable. So whilst we're very close to that now, I know others aren't and find it very difficult to get that investment, particularly non-dilutive funding. So there's not that much access to us at the moment. We got some asset finance through personal guarantees, but I think it's going to get a lot easier for us now once we've got these high profit margins. We're demonstrating those for a few months.
James, I wanted to ask you about the sorts of people who are at the table now that might be different from a couple of years ago. I've had a lot of conversations this week about the role of incumbents and strategics, and how important they become in later rounds. Is that something that, because of either you have off-takers and you have some of these agreements, you can demonstrate that? Is that important for what you guys look at a later round investment?
Yeah, I mean, I think on the commercial side, where relevant to the industry, offtakes are super valuable in providing the revenue visibility to growth investors like us at that later stage. Strategic play a really vital role across sectors, climate tech, being a key one. And part of that is they do have that ability to take a slightly more patient view than some closed-end funds. So not only are they adding strategic value, be that as the form of a customer or a supplier or just an advisor, but they can take that slightly longer view, which is always helpful. When we sort of look across the landscape, and I'm not sure all founders would agree with this, but we do think the seed and venture stage is reasonably well served. Obviously, it could always be better, but the number of climate tech rounds in the UK at seed or venture being closed since 2012 has quadrupled. So there's real progress there, more to do. And then we look at that later stage and the infrastructure investors. Many of them have raised real mega funds, more deploying into proven and established technologies. They've got an even higher barrier, I guess, for technology validation than growth investors do. But there's a lot of capital at that later stage, and you obviously have well-functioning public markets as well. And so the real challenge we've seen is at that growth stage, which is where Catalyst is playing, and also within that, the first-of-a-kind challenge for many of these climate solutions, in terms of novel technologies, that is, because the capital requirements there can be really significant. Growth investors like us who are willing to invest in hardware can help, but often, frankly, we can't always do the whole thing, and that's where I think governments continue to play a really vital role. And again, whilst the US story might be that bit less positive in 2025, I think if you look across other geographies, the story is really positive. You know, the UK government just this week has announced further funding to the British Business Bank to actually take stakes in startups. That's something the UK Investment Bank has been doing for a number of years with their £22 billion mandate. Canada has huge investment tax credits for deploying sustainable technologies. You have the 40 billion EU Innovation Fund. So I think it's really important the role that governments can play and that they continue to play that role. I think it's always easy to say that governments could do more. I think in this belt-tightening environment, they're doing a lot. So it's a case of actually getting that capital deployed to founders who need it.
Well, that is one of the good things about being in this country, is that it does seem there's some continuity versus some other places that are a little more volatile at the moment. And I did actually hear yesterday, I think this will be public today, the Startup Coalition just did a survey for the VCs for the climate tech sector. Now the valuation is about 42 billion just here in the UK in the climate tech sector. So that's something. Let me ask you another question then, in terms of what we're looking at in terms of metrics. What are investors that you're talking to looking for and either Paul or Sander, you can jump in, for the kind of signals? I mean, we talked a little bit about the unit economics and talking about getting your costs down in terms of per unit, but what are the other signals that people are looking for as you're talking at these later stages?
Well, they're mainly interested in and that's the same as what you say, in a business model where you actually make a profit, so that they know that they get their money back. Yeah. So they look at a good return, obviously. They want a profitable business, so that they have to, and they want also, what's that word in English? They want a guarantee that you collateral. That's the word I was looking for. They want collateral. And what I said also earlier, so all those things are very important. And then if you also offer something, and I think we do that and you do that too, if you don't offer those essential elements, but also something that people can invest with impact, that attracts them. So, but the main things are interest, profitability, and collateral. Right.
Yeah, I'll echo that. With one particular client we've got, I mean, with our website, I'm slowly just nuance, changing the language, that we move a bit away from the sustainability message, because when we start these conversations with either clients or investors, there almost be an immediate cynicism that we can't scale this, I've seen all this before. So it will get easier because this contract we've got with the kitchen company, now not only is it the same price now, it's reducing their damages by 1% a month, so it's saving them over £250,000 a year by using our product. But added to that is that for every tonne of polystyrene that we displace, we avoid 5.4 tonnes of CO2 emissions. So we've had 2 LCAs done, so that's in the public domain. So now that it's shifted now, that the supplier now we have to deliver, because they've dropped polystyrene, so the pressure's on now that we have to deliver it. So once that's over, we're going to do a big joint announcement on why they've changed, and I think there'll be much more onboarding after that.
Great. We look forward to hearing more about that. And James, in terms of metrics, I mean, what else? What's not obvious? Something that you guys, without giving away your secret sauce in terms of how you evaluate investments, but what do you look for that maybe isn't just typical in terms of looking for these signals about traction, looking for other ways of evaluating whether or not the company that you're looking at is worth investing in?
Yeah, I'm not sure we have any secret sauce at growth investing as such, but I think there's a few key proof points, right, that as a founder you want to have demonstrated before you get to the point of raising these very large growth rounds. And again, some of these probably should be obvious. Tech de-risking, so taking the technology where relevant from a lab scale to a pilot scale to a larger demonstration plant and showing it actually works in a real world environment. Commercial traction is really critical. I think in the past investors might have been willing to underwrite a business based on a pipeline of potential customers. I think today in this environment that is harder. I think you've got to be able to show ideally revenues and meaningful revenues today, but if not, contracted revenues and off-takes, that is hugely helpful. And then lastly, I think, again, I keep saying it, but unit economics are just so key. The willingness to underwrite businesses at the growth stage that are not delivering positive gross margins has reduced. It's not impossible, but it is tougher. And to the extent there is a cost down pathway that gets you either to positive gross margins or to just more attractive gross margins, that needs to be really validated. And I think when you bring all of those things together, then you can still get these large rounds, these large growth rounds done in climate tech. And an example of this again is a business called Form Energy, which many of you may have heard of out of the US. They're doing 100+ hour iron air batteries for long duration energy storage. It's a business we invested in last year. They raised a 450 million round. Now, how are they able to do that? It's all of the things I just mentioned. They have a commercial scale manufacturing facility. They have contracts with US utilities. And in this case, they do have a very impressive late stage sort of pipeline that you can go out and validate. And collectively, that's given the comfort to a fairly long list of blue chip growth investors to come in and continue to back the business. So I think those are the things that you can really focus on as a founder, and will help you getting funded.
Great. Well, we do want to open things up to some questions, if there are some in the audience. But before I do that, let me just ask each of you one last question. What's the one thing you wish you knew 4 years ago that you know now?
I would say, everyone in the audience will know this anyway, but take the money when you least need it for a rainy day. So that's what I would have done. Because it was very easy in 21, James said, to raise money, and I probably would have taken more in hindsight, which is a great thing.
Sander?
Yeah, I find it a very difficult question, to be honest with you, because I've been doing this business for such a long time, right? And
Sure.
I've been such a long time in the water treatment industry, and I learned a lot. I think, what I would have liked to have started earlier. But I was in doubt. Maybe doesn't work, or this is not a good business model. But you just have to do it. And I probably would have wished that I've done it a bit earlier than now. But okay.
Yeah, I think when you got into 2022 and the fundraising market started slowing down, I'm not sure many people expected it to be tough for quite this long. So knowing that would have been helpful in terms of linked, but providing companies with sufficient runway that they can work through some of those challenges, and again really get their technologies to the point of commercial deployment.
Great. Do we have any questions in the audience? There's one over there. I'm not sure how we do this. Is there someone back there with a mic? Or I can do it. I do. Is there a mic coming, or should I go out? Question over here.
Thank you. Thank you for the interesting panel. I was wondering, we heard kind of two different sentiments from James and Paul on sustainability messaging towards investors specifically. So I know, James, I think you mentioned that you're looking for a very clear sustainability angle. And I know you're also obviously focused on that within your fund. But then Paul was saying that they're trying to reduce that messaging a little bit more, especially facing wider investor landscapes. I was wondering if you could explore that a little bit more.
Yeah, it's a good question. We're not removing the message entirely. We're just placing it in a different position. Because, of course, we're just taking some of the fundamentals that, most importantly, our clients want, which in turn then leads them to closing investment rounds. And that's all around technical performance, price, and now even more importantly is delivery and fulfillment. We've got a 29-page contract with our suppliers now, and really there's only two bits of tension in it, really, how much we will hold in stock for them and how much they commit to that contract. So they're in all those pages, they're the two major points. So it's not removing, but as I said earlier, that we're displacing avoiding a huge amount of CO2, probably half at the moment. It will come down even further. But in the conversation I've had many, the most important thing at the moment is profitability, long-term contracts. And then only then, when we've got a sustainable business, can we disrupt a toxic material with our sustainable material. So I think it's just about moving the position of sustainability and ESG.
Yeah, and I think we're actually saying very similar things. For our mandate specifically, sustainability is really at the core of it, so we can't shy away from that. It's a dual mandate. We have to deliver positive, attractive returns to our investors, but we also have to deliver positive impact for people and the planet. So it remains very much, again, at the core of what we do, but I think what we're saying is that similar is that sustainability on its own is not enough for a business to get funded. You have to be able to demonstrate that you're cost competitive. You have to be able to demonstrate commercial traction. One is not a substitute for the other, at least in this funding environment.
Thank you.
Is there another question? There's one over here.
Hello, thank you for everything you've said. And just putting that together, perhaps as we close up, what I'm seeing is there's a bit more of a spread between what we used to call A, B, and C. C is a bit further out now, a bit bigger. A might last longer, and we're talking about Series B. So what does the panel think about? Should we start redefining the terminology? Should we be saying to companies, well, you're actually at a sort of A-B level. You're not quite at B yet. There's a very big gap there.
Well, I think it's a very good question. I think we were discussing this earlier before we went on. I think, it's if you've been in the game, the labels, kind of get stretched, and whether I guess the question is whether or not they still have utility. I think that's basically your question about, or do we need to redefine them in some way?
Yeah, for us, the labels don't actually mean that much. We can see companies at Series B and their financial profile and their maturity is very, very different to the next company that will come along at Series B, which is why I say we generally invest Series B plus, but that's not really the defining characteristic for us in terms of what we think of as a growth investment. It's about tech de-risking, product market fit, and typically for us, we're kind of looking for 10 million plus of revenues. And if a company's at Series A and demonstrates all those things, then we have the flexibility to invest at that point as well. And to your point about stretching out the Series A, I think that's probably, again, in part driven by the funding environment we've been in for the last few years, and investors sensibly trying to give their companies that bit more runway at Series A to actually execute and hit their milestones before they have to come back to market and shown that they've delivered, again, the proof points that growth investors want.
Any other views? Okay. Does that answer your question? Okay. Is there another question? No? Well, I have one more to ask, which is basically, I suppose, again, apologies, James, I keep pointing things at you, but do you expect, I suppose to the gentleman's question, there's kind of a building on that, are cap tables, do we expect them to become messier as they get to that point? If people are having to, as you say, stretch things a little bit further, find non-traditional ways of getting through, does that add complexity to the cap table by the time you're looking at something? Or do you anticipate that might become an issue in the coming years?
Again, it obviously does vary. I'd say in the last couple of years, again, just given the funding environment, you have seen more structured rounds being done, more convertibles and things like that, potentially different liquidation preference and different stacks of capital, which can make it more complicated, but equally it's certainly not insurmountable, and these are great flexible structures to put in place and help your business kind of continue to execute. And you can always clean up the cap table at a growth round, and that's something we often do, be it if existing investors want to go out, then giving them a bit of secondary, or converting, obviously, a lot of those convertible notes and bonds. So it is something we're seeing. It's not something I'm particularly concerned about, I guess.
Well, I think, you're in a different space. I was having a conversation with someone yesterday who's in this kind of a SPAC space, and for exit, but we got a big laugh around the table when we were discussing how messy are the cap tables you're seeing now, and it was. I suppose people are just having to do what they have to do to get through. Do we have any final question from the audience? Is the lady back here again, please?
Sorry, me again. One more question to Paul, because you've highlighted basically also your scale-up journey for cost reaching price parity, and you've mentioned how the Innovate UK funding for one of the plants was integral to that. But I wonder what other key milestones there were to reaching that point, because I know a lot of companies struggle with that during scale-up.
Yeah, it's another great question. It's been a struggle for us as well, and I think the most important piece of paper I have in the business is my risk log. I'm flabbergasted at how infrequently investors on pitches ask to see that risk log. But anyway, so it's the mitigation of all those risks over a long period of time, really, which has really got us to that place and bringing the verticals in. So in its simplest form, the raw materials is key. So we've ultimately mitigated that. The labour cost was also restricted, so we've done a huge amount of work on that. So that's now at an acceptable level. Also the yield that we get, the factors that we choose. We've made some mistakes along the way because it's a new material. So it's real laser focus on engineering, and all those come out from the risk log. And we discuss it at length for a whole day of the board once a year, and then it starts off after safety, of course. Every meeting starts with safety, but then after that it's about the risk, and they drop out. So it's long and arduous, but there's no shortcuts to it, would be my answer to that price. And I knew it was coming, which is why we carried on. And if I didn't think it was coming, then we probably would have stopped. But we knew that price parity was there for the taking.
Thank you.
Right, before we close, any final thoughts? Anything you guys want to share? I mean, I suppose, no?
It's been a great panel. Thanks very much.
Oh, well, thank you all very much. And I could invite you to come to wickedproblems.earth for other great conversations and content. So get the plug in there. And please do feel free to talk to our folks here. Thank you.